What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 15th of 2021. Well, folks, I hope you all are having a fantastic day wherever you are, and if you aren't having a fantastic day already, I bet you will after you hear this exciting news that over the last couple of hours, we've got near confirmation on a weeks-long rumor that the SEC may be on the verge of approving the first ever Bitcoin ETF. This is something that we have looked forward to here on this channel for years, going back to the first major bull market where we started this channel back in 2017. And it's amazing to see that this might finally be coming to fruition. Now, again, there are no absolute direct confirmations, but we're at about a 95-98% confidence level. And we'll talk about the things that not only solidify it, but I also want to dive into the details of what this entails. And not only why this might be a good beneficial thing in the short term to give broad exposure for Bitcoin for a wide range of investors who maybe haven't been holding Bitcoin before, but also why there may be some downsides in this case. Why this ETF product isn't the most desirable version to establish long-term demand and consumer protection for investors, which is really what the SEC should be after. So we're going to be talking about all that, but we also have got a sponsored review towards the end of the video on a new DeFi protocol called Bumper Finance. So stay tuned for that. You guys won't want to miss it. All right. So guys, let's go ahead and talk about how we can be so certain of this decision. Well, first off, the major component here that's important to understand is some of the kind of behind the scenes activity we're seeing. If you dive into the SEC documentation, if you dive into the filings projected by these companies producing these ETF contracts, we're seeing lots of key telltale signs in this case that they're starting to get their ducks in a row, so to speak. They're making sure to make small adjustments and get things prepped for a launch. Not to mention the SEC has made it very clear back a couple weeks ago that they wouldn't get in the way of an SEC certified ETF that is backed by Bitcoin futures. Right? So we've got all these things coming out here, and I think the icing or the per se cherry on top is the SEC investor education tweet that just came out saying, before investing in a fund that holds Bitcoin futures, make sure you carefully weigh the potential risks and benefits, even though before we've even got a Bitcoin futures ETF coming out on the market. So these are all the kind of telltale signs that it's nearly confirmed at this point, guys. Well, I want to go ahead and talk about what a Bitcoin futures ETF means and why in the short term it may add some benefits, but also may come with some downsides in the long term. So in the short term, we can see that it's been playing a great role here for Bitcoin's price. And we've been doing exactly what we've been kind of talking about here going into the close of the year here, where we would bounce between higher ranges of resistance and support and zigzagging our way up here towards the previous all-time highs at 65K. We just bumped around the big even level of 60K. And again, it looks like this is going to happen even well in advance from our expectations for November, December, towards the end of the year. It looks like we may get something here really in the next week in regards to revisiting the previous all-time highs. And it lines up perfectly with the announcement coming out that we may be seeing a tradable product within the next week or so. Right? But let's go ahead and talk about what a Bitcoin futures ETF looks like versus a spot ETF. Well, the title itself gives it away in a sense. These ETF products that could be launching sooner than we probably expected are going to be ETFs that generally do try to track the price of Bitcoin as an asset, or probably will stay around Bitcoin's average price. But they're not really backed by real Bitcoin. These ETFs are backed by futures contracts that are purely paper products in this manner that allow for people to be able to protect themselves, much like the vast majority of derivatives products, against price differentiations in this manner. So you're probably familiar with futures contracts. You may have heard about options before. All different types of derivative products, contracts for difference. There's all types of different ones out there. But this is likely going to be basketing a variety of futures products inside of these ETF products in order to give people an easy way in their brokerage account, their IRA, their 401k, any type of investor, not just accredited, but retail investors, to be able to have that exposure in their retirement accounts or their standard brokerage account. And that is really great in the sense that it's going to give people, for the first time, the SEC has finally built a consumer-friendly product that's going to get exposure out there. The biggest problem about it is it's not what people think it is. And it's not going to set the kind of demand that people are probably expecting it will for Bitcoin. Because there's the futures-based ETFs, that could be deployed and be readily available today, right? Provide that exposure. But then there's also spot ETFs. And these are ETFs that are backed by real Bitcoin. Not, I always use the term sometimes physical Bitcoin. Yes, there's no such thing as physical Bitcoin, but real Bitcoin in cold storage backing up a certain amount of Bitcoin per share that's issued. This is exactly how Grayscale's exchange traded note product works, or GBTC as it's probably known as by most of you out there. And the thing about that is, what's so great about it is that it actually set a lot of demand for Bitcoin. It drove Bitcoin's price up. The problem is that we're seeing very, very similar problems here with a futures-based product as we do with ETFs like GLD for gold, which basically has 1 actual ounce of gold in this case, or amount of gold per 100 to 200 shares, right? And the problem with this is that even though it does provide that investor exposure, and it does bring a sense of maturity to the asset class and broadens the overall user base who might be interested in owning spot Bitcoin, it doesn't set substantial long-term demand. It really only kind of brings about a more mature image for crypto, a mature, I think the term mature is kind of harsh on crypto in that case. I think overall a broadening acceptance of the asset class towards an audience who may have not traded before. But this has been something, again, it's not so much a surprise. These comments from the SEC came back a while ago, and this has been something that's been talked about for some time. And I think that there are a couple reasons for this. You could view this in a positive light, taking the benefit of the doubt with the SEC, or you could see it in a institutional kind of cartel nature where they're trying to suppress Bitcoin. The more positive one here is that with a futures-based product, they're hoping to test the waters here in this case, get something out on the market, and see how it actually trades. And I think there may be some arguments to be made there for that, but I really got to say here that for me, I don't see any rational justifications for not allowing ETF products that have actual Bitcoin backing it. The only reason I would think that they'd want to do something like this is to, much like with futures contracts, suppress the asset price, dilute supposed supply in this case from the already existing 21 million coins to paper products in this case, where they're basically, in a sense, printing artificial Bitcoin, right? Instead of that capital, those inflows going into buying Bitcoin on spot or buying an ETF that actually needs to back its product, in this case with real Bitcoin, we're seeing a futures product in this case, where you can basically issue unlimited levels of futures in this case, especially if they're not physically settled futures contracts. That's another way where, again, we could see some positive benefit. But I don't think that's what we're seeing here from my analysis. And I could be getting it wrong. But again, that's the key thing here that we're seeing. And now, why is this even also bad for retail in this manner? Why is it something that we should be, again, kind of turned off by? Not only the fact of further possible dilution in this case, breaking Bitcoin's beautiful trustless element that there's 21 million Bitcoin that will ever be mined in this case. Well, another element that we need to keep in mind here is that, and this is something that Willy Woo put out, he said, if a Bitcoin futures ETF is approved, in my opinion, it will be an expensive way to hold BTC. Because when you're going through and having a ETF product that's backed by futures contracts, whether it's Bitcoin or any other asset, futures contracts settle under certain time frames. They're like most derivative products that provide some degree of protection or allow you to hedge your bets in some direction on a given asset. And the problem with it is that, in a sense, you could say that this ETF has underlying futures that are rolling in this case. They're having to be resettled in this case, right? And because of that, there are costs associated with it. There are a ton of middlemen involved in this process, and it's going to be similar to Grayscale's ETN. One of the biggest downside of Grayscale's ETN, the Grayscale GBTC product, is that it has added cost every year. It has a management fee, and no one wants that. 1% to 2% a year starts to add up big time if you're holding Bitcoin for the next 10 years. It could really start to dent your profits. Whereas a broad ETF product that just has physically, held Bitcoin in cold storage could probably have a fraction of that, if not nearly no cost, right? So these are the things here that really make the news a little bit disappointing. But overall, again, I want to make it very clear, guys, no matter what kind of incentive the SEC has here, or whether or not this is going to, substantiate Bitcoin to really rally up towards 100K and beyond simply from this ETF announcement. I want to say very clearly that this is definitely going to probably be enough to press us up to the previous all-time highs and kick us above there in that case, especially as the product launches. I really don't think this ETF launch is such a blowout in this case that it's going to be a signal for a market top. I really don't see it. And I don't think it's also going to be enough of a sell side pressure in this case. Like once it's, buy the hype, sell the news. I don't think it's going to be one of those type of events, because I think what the market is waiting for here, on a more positive note, is for that physically backed Bitcoin ETF, the real Bitcoin and cold storage per share in this case. That's really what's going to kick off the cycle, because again, I think this is a bit of a testing the waters. It's the first kind of product out in the market. And then afterwards, it's inevitable to some degree that we're going to see this. I think that there's going to be a major demand for people who are actually on an institutional level looking to expose themselves to Bitcoin. I don't think many of them are going to settle for a futures-based product in the long run. I think they're going to want to have that more trustless degree in this case, albeit it's custodied, that at least there's real Bitcoin backing it in this manner. Or at least they're going to want to see physically settled futures contracts where people can actually, like backed in this case, they can actually request the actual underlying Bitcoin. So anyways, guys, I've rambled on about this. We've kind of talked about what we have to work with right now. They haven't launched yet in any means. And again, I want to be very candid with you guys about the good in this case, but also the bad as well that we have to keep in mind. So I'm curious to hear what you guys think overall. If you guys think this is good news or bad news, I want to hear down below in the comments, but let's go ahead and dive into the conversation around Bumper Finance. Alrighty, everyone. So in today's sponsored review, we're going to be taking a look over a new DeFi protocol that is ironically enough very fitting to what we talked about here today when we're talking about futures and other derivatives-based products. It's a product known as Bumper Finance, or bumper.fi for its actual web domain. Now, to put it really simple, Bumper Finance does something that, in my candid opinion, I have not seen any major DeFi protocol do in a simplistic way and provide a very key and vital service, which is price protection. I think of it as an ultimate stop-loss protocol for your assets. Bumper Finance aims to do one key thing: allow you to ride the wave of your assets, and if price, when you start initiating protection, goes below a certain threshold, have the ability to liquidate your position and actually cash out of the market in a decentralized way. And that's the really cool thing here is we've been talking about this Bitcoin ETF product today backed by Bitcoin futures. Futures contracts, like options and many other types of derivatives, are protections. They're a means of hedging yourself, hedging your bets in this case. You're long on crypto if you're holding ETH, Bitcoin, you name it, any type of crypto asset, but do you have the protection in place in case things go wrong and things don't go your way? And that's exactly what Bumper aims to do here. They're doing something that I haven't seen any DeFi protocol do in such a simplified approach. By utilizing, in this case, liquidity pools and high frequency features, they're able in a decentralized way to allow you to protect your underlying principal position in case things start to go south. So let's go ahead and start to try to visualize what this means and why what Bumper offers in this case as really an early stage DeFi protocol may be something really important to watch for going forward. So let's go ahead and talk about an example here, right? Let's say, for example, you're holding Ethereum in this case. You bought in a position here around $4,000 in price, and in this case, you want to protect that if ETH were to go down a substantial degree in this case, right? Let's say if it goes down 5%, which again, if we're doing the math here in this case, right, it's $200. So basically, if we go down $3,800 for Ethereum's price, then we want to be able to go back into a stable coin. We want to go into something that's stable based in this case, and likely in this case, USDC. Right, in order to protect us from a further correction. We feel that, for example, after a 5% or 10% or 15% dip, we want to go back to fiat because we think that, historically speaking, if it goes down that far, it's going to continue to go down. And that's not a guarantee in this case. History doesn't always repeat, but it's a protection similar to a stop loss on an exchange that we can set for our underlying assets. And that's exactly what Bumper Finance offers in this matter. It, for the first time, really allows you to go, for example, to an AMM like Uniswap or SushiSwap or on other different types of layer 1 protocols, go and buy an underlying asset, and then through Bumper, by paying a small fee in this case and small cost, you're able to have that underlying protection for your assets while also still maintaining the potential upside, in this case, the upside benefit. So you're mitigating your risk and you're also having unlimited potential upside. That's the really cool thing about setting, in this case, an effective stop loss or having hedges, in this case, through derivatives, is that you can mitigate your potential loss and have unlimited upside. Again, it's not going to be unlimited, but you see my point here. You have a much more favorable amount of upside with mitigated risk here by being able to have this kind of price floor that you can set into the Bumper Finance protocol. So there's a really cool walkthrough here that I highly recommend you guys watch that actually goes through and showcases here back as far as May of this year. The team's been working on this protocol and actually has had some degree of a working product, right? So overall, the way that it works here is that you plug in your wallet to the actual protocol. It showcases all your list of different types of assets here that you have within your wallet. And then once you choose an asset you want to start getting protection for, right? You choose the amount of your asset you want to protect. So in this example demo account, they had 100 ETH. They decided to protect about 60 ETH from the account, or about $87,000 of positions. It's a big chunk of capital. It's good to have some protection for. And then they went on to set the asset value floor. Now again, in these examples, you can see here that there is a certain percentage at the top, a percentage at the bottom. The percentage at the top is the protection, in this case, the price floor that you're setting for the asset, so that if your value of your portfolio, originally $87,000 at the start or initiation of this protection, goes to $78,700, right? When I say that there's a liquidation in this case, it's not like a derivatives platform where you're getting a margin call and you're losing everything in the line. What happens here is that the protocol through the liquidity pools will actually, in this case, give you, as you have an IOU redemption once you file for this protection, to basically give you 90% of your original position in the form of USDC, right? So you can actually claim, in this case, real liquid stable coins after you've initiated this protection, and if your assets go to this underlying price floor, value floor, right? And you could do it for 80%. So if there's a 20% correction, or 95% in case there's a 5% correction, you can get really creative here in this matter. And the underlying percentage here, this 1.5%, 3%, 6%, what this is offering is it's the cost that you're going to have to pay, or the premium you're going to have to pay, so a form of interest, if you will, that you're going to have to pay on top for that protection over a certain fixed period of time. And the important thing is that you don't have to do this for some fixed window of time. There is a really wide range of time you can do this in. Again, now the minimum is 2 weeks for this protection, but you can have this as a rolling policy in this case, or choose from a variety of options that allow you to approach it in different ways. But again, you can effectively allow this protection to keep going through and paying the premium on it. Right? Now, what's really cool here is that for Bumper as a protocol, this is going to allow for not only protection in this case, but also for the ability as well for individuals to start getting some form of yield, right? So you can provide liquidity to the protocol to allow more and more people to actually get protective policies, and do that through yield farming in this case, right? So you can actually get some kind of yield on your underlying assets. So this is something, again, what I love about DeFi protocols is there's really like two ends to the stick here. You've got a service that's obviously very valuable in this case for people at the end of the day to have that consumer protection when you're investing on your positions, especially in a very volatile market. But outside of that as well, you can go about offering an opportunity for people to get that kind of yield. Now, again, we're going to see how it goes in regards to the actual launch of the protocol, but you do get bump rewards as well by providing the liquidity provision in this case. So there is a native token to the protocol in this case, guys, so you can learn more about it if you go to the website. But again, I want to let you guys do your due diligence on it and dive into it. But this is overall, as a concept, something that's really interesting to me, because I've been someone who has been in the same position as a lot of people. I'm trying to step away as far as I can from utilizing centralized exchanges. In fact, DeFi AMMs like Uniswap will in many cases give me a better deal than I would get utilizing Coinbase Pro or standard exchanges like Coinbase. But the problem that I kept running into is that whether you're working on a hardware wallet or working with MetaMask or another mobile phone software wallet like Digifox, the problem that you come into is that you simply don't have any means to protect your underlying positions. And although I think Bumper Finance Overall, is going to start with some of the major altcoins in this case, and predominantly Ethereum. This provides a major degree of coverage for the crypto space. As you guys know, we're big on a lot of the major DeFi blue chips and Ethereum as an investment. So again, I really think overall that what Bumper Finance is building here is something that's been needed in the space for a while, and it's done in an incredibly simple way that kind of serves as a complement towards the growing space of AMMs and broader adoption of self-custody of crypto assets. So that's my general take overall when it comes to Bumper Finance. I'm really curious to hear what you guys think down below in the comments. I'll leave some links so you guys can dive into Bumper Finance. I'll leave a link directly to the website so you guys can check it out and learn about all the details in relation to the protocol itself as well as the token if you're interested. But again, one key thing to understand here about the token element here is that you're going to need the Bump token in this case or a little bit, and that can help you auto buy the token in order to utilize the protocol. And I like this in this case. I like seeing utility token adoption in this case, but also making it simple so the protocol can be self-sustaining in the long run. There's some other key accolades that I think are important to mention as well that I think is a pretty big standout here, that the protocol has not only already raised a good amount from early stage investors, but they've got a lot of early stage members on the team who also helped with Haven, known as Synthetics Protocol today, one of the biggest derivatives protocols. So again, I think they're coming from a pretty solid knowledge base here, a lot of the talent on the team in order to build what is Bumper Finance here today. And I think that it's going to be setting the stage to get more people thinking about that protection for their underlying assets. That being said, everyone, though, that's it for today's review, guys. I highly recommend you guys give it a check. And outside of this, well, I hope you guys are excited about the Bitcoin ETF news. There's a lot going on in the space. And again, we stuck to our convictions that this wasn't a bear market back in May. And I think it's starting to pay off. Anyways, guys, hope you're doing well wherever you are. Have a great rest of your day, and I'll see you all in the next video. Take care, everyone.